In this presentation, we will record the adjusting entry related to accrued interest or interest payable within QuickBooks Pro 2020, QuickBooks Desktop 2020. Here we are in our Get Great Guitars file. We currently have the Open Windows open. You can open the Open Windows by selecting the View dropdown and the Open Windows list. We're now going to be dealing with accrued interest. To take a look at what that will entail, let's first take a look at the financial statements. We're going to go to the Reports dropdown up top. We're going to go to the Company and Financial, and then scroll down to the Balance Sheet Standard. Within the Balance Sheet Standard, we're going to change the dates in the Customized Reports. We're going to change the dates from 01/01/20 to 12/31/20. Actually, let's make that 01/01/20 to 02/29/20. January through February 2020, February being the cutoff date for our adjusting entries. So what we're going to do now is have interest payable, in essence, for a loan that we have on the books that has accrued interest, but for which we have not yet paid. If we scroll down and take a look at the example, we're going to say that we have the $5,000 loan, which is included in the short-term payable, loan payable. If I double click on that, you'll see we have this $5,000 loan. That $5,000 loan is supported by this worksheet. We have two loans, this being the long-term loan, this being for the short-term loan. Now with the short-term loan, the design of the loan is different. And notice that every loan could be designed a little bit in a lot of different ways. We often think of loans as being designed to have one set payment that we pay every month. But that's only one way we could set the loan up. We could set the loan up so we have the full loan and interest due at the end of the time period, or possibly we could set another common way is to have the interest be paid throughout the time period and then pay the principal back at the end of the loan period. In this case, we're going to say that we took the loan out, and the way the loan is set up is that we don't have to pay interest or principal until the loan is due at the end of the loan period, which is going to be the 6 months, it looks like here. So what we have then is kind of like an amortization schedule, but it really is just an increasing of the principal, right? Because we're going to have interest that will be increasing. That'll increase the balance. That'll increase the principal. So at the end of this time period then, we're going to owe $5,152 instead of the original $5,000 that we took out due to the interest that is going to be accumulating throughout the loan. It's only been 1 month so far. Therefore, the original loan was $5,000. We owe back $5,000 plus the rent on that first month, $25,000. So we have to record the fact that during this time period, we incurred interest expense of $25,000, even though we didn't pay it. Now, obviously, this is a fairly small amount here. It might be immaterial in this case, but just note for an example problem, it could be material, be something significant, something that we would want to record, or something that a creditor would want to see on the financial statements. So the concept is sound, even if this particular number might be fairly small to warrant an adjusting entry. So that means that we need to put this on the books as a payable, something that we owe. We've accrued a liability. We've incurred the expense because we used the money during this time period. We owe this at this point in time. We have to record the expense during this time period and the related liability at this time. So let's go to our QuickBooks and think about how we can then do that. We're going to go and close this back out, back to the balance sheet. What we need then is some type of liability account. It should be a current liability account. It could be called accrued interest, or it could be called a payable. I like to call it a payable. So we're going to make interest payable. Note, you could put it into the loan and say, well, it's part of the loan that's going to be due. But typically we want to have the loan broken out separately. Here's the principal portion of the loan, and then the accrued interest will be a separate account. So that's what we will do here. The other side then should be on the income statement, which is going to be an expense that should be within this time period, February, for interest expense. So to do that, traditionally, we would go to the company dropdown. We would go down to make the journal entry. If you know debits and credits, you could simply enter the debit and credit here. However, we're going to go ahead and use it in a register format because it's a fairly simple journal entry and therefore it's not too difficult to do so. So to do that, however, we can't use the interest expense because it's a income statement account. We don't have a register for it. We need a balance sheet account. So therefore, we're going to have to first set up the balance sheet account that's going to be called interest payable. Then we can use the register to enter the adjusting entry into the register for the interest payable account we set up. Let's take a look at that. We're going to go to the lists drop down up top. We're going to go to the chart of accounts. Within the chart of accounts, we're going to go down to the bottom to the account drop down, or in this case, the rise up. So the account rise up, and we're going to go to the new, and then within new, we're going to select the account that we want. We want to make it an other current liability account. Other current liability type of account. We will then continue, and then we'll enter the account name, which is going to be interest payable. Interest payable. So that's going to be our account. It's going to be an other current liability. We will then say save and close. Save and close. Find that account. There it is. We want to then go into the register for it. To do that, we're going to double click on it. We see our familiar register. You just got to remember which account you are in so you know which account is going to be increasing and decreasing. And then we'll just assign the other side to the other account form here. It's going to be dated as of the end of the month, as is all adjusting entries. That's our cutoff date. And we're going to say that this needs to be increasing. The liability needs to be increasing by, what did we say? That whopping $25. $25 increase. And then the other side's going to go to the other account, and that was going to be the interest expense. So if I select the drop down, we should have an interest expense. There it is. Or we could simply start to type interest. And there we want the expense, not the income. Make sure you pick up the expense, not the income. I'm going to put the memo, adjusting entry for interest payable. And there we have it. I'm going to close this back out then. Close this back out. And then we see here in the other current liabilities, there it is. There's that $25. We're right on it already. That's nice. If I double click on it, then there's our adjusting entry. There's our memo. Note that it is a journal entry. As we double click on that $25, we get to the register with the increase. If we double click on the journal entry here, we then see the debits and credits. There are the debits and credits. Closing this back out, closing this back out, closing this back out. The other side then on the profit and loss report. To get there, we go to the reports drop down up top. We go to the company and financial. We're going to go to the profit and loss standard. Within the profit and loss standard, we'll change the dates up top to 01/01/20 to 02/29/20. There we have it. Scrolling back down, we're looking for the interest expense. So interest expense is here, the 621. Double clicking on that, we see the $25. There's the adjusting entry. It's nice to see the adjusting entries will all be journal entries. So that's one way you can kind of differentiate them. And if you have the memo with the adjusting entry, that's useful to have as well. Double clicking this, you'll then get to our register once again. Double clicking the general journal, we then get to the journal entry. Closing this back out, closing this back out, closing this back out. Now you'll note this is more of a traditional kind of adjusting entry. Most adjusting entries will have a balance sheet account and an income statement account. They'll have some kind of timing difference or timing component to it, which are income statement accounts or profit and loss type of accounts that we will be dealing with. Let's take a look at the trial balance, check our numbers, and then push forward. We're going to go to the reports drop down. We're going to go down to the accounting and taxes. We want to take a look then at the trial balance. Then within the trial balance, we will change the dates to 01/01/20 to 02/29/20. That's January through February. Then check your numbers through here. See if they tie out. If they do, great. If they don't, check the dates. And then go in and make any adjustments you can using the auto zoom. If you have a problem and you want to push forward anyways, we will have the backup files so that you can basically restore the backup files and start at any point you want with the numbers that we have as we go.